I want to give you an account update of what's going on. I have a AG short puts, and as you probably saw, the entire market, commodity market, kind of fell down on Friday, and obviously I got hurt by that. So I want to talk about that, and so let's begin, and I'll show you the exact stats of the position. So it's a short put position. It's currently down 53% of credit, and the position is it's a 4.9 put with 46 days to expiration. When it was opened. It was opened on December 11th, so right after the rate cut, and December 12th, which was Friday, is when prices just kind of fell down pretty strongly. So my fill price was 0.026, and my take profit is 50% of credit, and I will roll or close the position at a negative 50% loss, depending on the news, obviously. So currently, there are no changes in the fundamentals. It's basically just a pullback. Right, and because the position is very directional, well, it's just a short put, then obviously any massive moves against me or to the downside will be pretty, pretty horrific to say the least. But it's not the end of the world. The position size is pretty small, so it's 3 contracts for every $100,000. So I collected about $2,000 in premium per 100K. And about 28K in margin impact here in Canada. The current trend is an uptrend for copper. Volatility was really good when I opened the position. It actually dropped at the same time the price dropped, which is pretty typical with commodities. They crash upwards. When they go down sharply, it's kind of like a pullback. It's kind of like the S&P going up by like 2%, right? It doesn't crash. It's just kind of, it just goes up. And volatility usually goes down when the S&P goes up. So here commodities, not all of them, but copper is one of them. When price goes down, the volatility tends to go down with it, which is what I was hoping to see, but price moved just way too much. Now, there is a critical reason for the price to increase. Now, rate cuts are very bullish for metals, especially for copper. It creates more demand, more housing projects and whatnot. That's one thing. The second thing is there are a few mine disruptions that are ongoing, and they've been also pretty problematic on the supply side. So supply has been really shrinking, and there has been more demand from U.S. companies. They have been buying copper more and more because they are afraid of tariffs for refined copper in 2026. So these are pretty strong reasons for the price to stay elevated and not change its course. So there are no critical reasons for the price to go down at the moment, at least. And the news obviously are pretty critical. So this is why I chose to sell short puts. I think it's pretty self-explanatory. Now let me show you what the position looks like on the graph, and from there I want to tell you exactly what is my plan going forward with this position. And obviously it's only possible to kind of take this kind of loss, which is again not that huge, but it's because my position size is only $2,000 or 2% of premium, 2% of total account in premium. So position size is pretty small. So let's take a look at the graph. So this is the position. Short strike is at 4.9. It's a short put, like I mentioned, and I opened it on it was Thursday, December 11th at the morning, give or take. So around, it took me a while to get into a position, but I got into it eventually. But obviously price went up 2.76% on this day, and I got into position probably closer to the end of the day when price was already up. So you can see the current trend is somewhat of a slow moving uptrend. It's nothing like silver, but this is just looks to be just a normal pullback because none of the fundamentals have changed. The price should stay either elevated or just kind of move sideways, which is what I'm currently expecting. But obviously price went down quite a bit, and it was a day after the position was open, so the position didn't have any time to decay, and still pretty far away from my short put. Now, what is my plan? Well, my plan is to see what's going to happen next week. If price keeps dropping aggressively, which is very important, if it just kind of keeps going down but not that much, volatility will fall and position will be good in just a few days. But if price keeps falling aggressively and I see that fundamentals are not changing, then I can roll the put to the next expiration, which will be the same future contract, and I'll roll it out in time and then down. And currently, based on the current credit, I can roll it down to about 4.65 without collecting any credit and without paying any debit. So it will be basically a zero transaction for the most part. I will actually collect a little bit of credit, but it's negligible. So I will be increasing the time that I have to expiration by another 30 days, give or take, but my range will also increase quite a bit, right? So for copper to go down all the way will be pretty hard. Now, this is all possible because this is a pretty small position to begin with, which is obviously key, especially when you trade directionally. Things can go against you really quickly if it's directional. Now, I sold put on purpose because when commodities go down in price, volatility usually goes down with it. So let me just show you what it looks like, because volatility did go down for copper on this day, even though it was a pretty volatile day. So you can see this is basically the last day. So it went down, not a lot, but it did go down, right? So you usually expect volatility to go up if things crash. Well, commodities, it's a bit different. Natural gas is the only one that can crash down and up, with volatility expanding, but usually it's not the case for copper. And I know some people say, yeah, well, copper did crash here, but before it crashed, it went up all the way up, right? So it's kind of like the same thing as saying, the S&P just crashed all the way down and then it crashed back up, right? But it just kind of reversed the price movement, right? So, but rule of thumb, when price goes up quickly, volatility expands in commodities. When price goes down quickly, volatility usually contracts, which is why we have some benefit when we sell puts. But this move was just a very big move. Now, what happens if, for example, we end up rolling the position, or before we even roll the position, price keeps going down aggressively even more, but I see that fundamentals have changed. I go through the news and fundamentals have changed, right? What do I do then? Well, then we can roll the position to the other side, right? If we need to, or I'll just end up closing the position depending on what's gonna be the P&L on it. But if it's nothing major, we can roll the position to the other side. I don't have the exact number, but it's probably gonna be really far away because calls are really expensive, right? And then you can just kind of enjoy the price crashing, and then you're making money on the call side. So there's many ways to deal with it, but and same thing if I end up rolling it to 4.65, if fundamentals don't change, and then they change, then I can either roll it to the other side or decide to just kind of close the position. So my point is this is all possible because the position size is pretty small. If it would have not been that small, then it would just been too painful, obviously, and margin requirements would have been too big on the account. So currently I'm down like 1% on my total account, and obviously I work with pretty big sums of money. But at the same time, I look at the percentage, which is what matters at the end of the day. So I'm still up 23.4-ish% of the year, so still doing really well, even though with this unrealized loss. We'll see what's going to happen. I do think it's going to be okay either way, because we do have the fundamentals on our side, and it's just one of those situations where you gotta know that you can that you can fix this position and still have the mindset that you can also close the position if fundamentals do change. And fundamentals for me, they tell me what to do basically. And trading neutrally, which is what I usually do, is a very, very different, because a move like this, if I would have had a neutral position in this case, would have mean that position would have been up by quite a lot, because volatility fell down and all the meat is on the call side anyways, right? But this is a directional position. I don't see a reason to sell a strangle here. It would have been pretty dangerous to have any exposure on the upside when the fundamentals are all pointing up. So if you have any questions, let me know. Just kind of sharing what's going on in my mind and what's gonna, what is my plan going forward. Thank you so much for watching. If you have any questions, let me know, and I will catch you in the next one, and I'll give you updates on this position.